Good evening, everyone, and thank you so much for joining us for our seminar. This is the first of our Real Estate and Finance in the Golden Years seminar, so I'm really excited about this series. There are just so many topics in terms of people that I've been talking to, and then myself and my family personally, where this whole idea of aging and all the different challenges that we face as we age and as our parents age is really coming home to me in a lot of ways. So with that, our first one is transitioning to your next home, which is on upsizing, meaning going to a bigger home, downsizing to a smaller home, or maybe even relocating. So we'll just go ahead and launch right in. A little bit of an introduction for those who don't know me. My name is Jean, again, Jean Joe, and I'm the broker and owner of Perisson Real Estate. The word Perisson comes from the Greek word for abundance and overflow. And basically, when I started the company, I really wanted to focus on this principle of abundance and the fact that we have so much that we can share with one another and help each other to win. The more that education and things that we get out there. So actually, since the founding of the company in 2016, I've been holding seminars. And then in 2020, with the pandemic, ended up kind of converting over to online seminars. And then since then have been doing a little bit of both. I wouldn't call it a hybrid. It's either online seminar or in person. The beauty of the online seminars is that anybody can tune in from anywhere. The nice thing about the in-person seminars that I love is being able to meet people face to face and being able to answer questions and whatnot. But really, these seminars are a product of the overflow of this principle of abundance. The fact that we do have so much that we can share with one another. And so I regularly invite my fellow colleagues, other real estate agents, to join us for these seminars, because I think if they can benefit from it or if they can share it with their clients, that's great. I think it's all great, and that we elevate one another. So that's the purpose of these. Just to go through a little bit of an update of an outline of what we'll be talking about. I always do a quick market update. I focus, because I'm here in San Mateo County, I focus on San Mateo County, but in general, the Bay Area, San Francisco Bay Area at least, it's pretty similar. It'll have some differences if you go to East Bay or San Francisco or the South Bay, but they're fairly similar in terms of pattern. And then from there, transitioning to your next home. So what that process looks like if you're planning to buy and sell your existing home and buy a new one. And then from there, transferring your tax base with Prop 19, because there is, since Prop 19 was passed a few years ago, there's a way that you can keep your property tax base with you. And then Elsie Wu will be from Abundance 99 will be covering bridge loans, which I know a lot of you are very interested in. So you can, she'll be sharing some of that, how they work, and some examples of how they've been able to be effective for our clients, and for her clients. And then announcements after that will be very quick. So very quickly with the real estate market update. One of the first metrics that I like to use at every market update is the median sale price. Median sale price has to do with when you have a price at which the number of homes that are selling above it is equal to the number of homes selling below that price. So this is a look at single family homes in San Mateo County. And again, in other parts of the Bay Area, it can be very similar. With some differences. This goes back to January of 2005. And as you can see, at that time, we're somewhere in about $700,000 to $800,000 range for a median sale price of a single family home. In 2008 and 9, that dipped down to almost 500,000. So just a little over 500,000. And so, as all of you know, that's when the last Great Recession was, where the Great Recession was. This is when I started real estate. So it's only been uphill. It's only been good from there. But literally things were not moving at that time. And so you could see the median sale price, we're hovering right around 500,000. At that time with my colleagues, we would all be talking about how when I get my $1 million listing, I'll take everybody to lunch, because that was a big thing. Well, by the time we hit 2014, 2015, $1 million was the median sale price average. And since then, in the years after that, over the next 6 years, we saw it continue to go up and up to where by the time we hit 2018, we're solidly hitting 1.5 million, up and down, of course, for seasonal trends and whatnot, and market trends. And then when we got to, you see here where this red line is the COVID lockdown in March of 2020. From there, there was a brief pause for a couple months as people weren't sure where things were going to go, and you can see it a little bit steady. And then starting 2021, the market just jumped. And so you can see this peak here, peaking here. April, this all-time high was April of 2022 at $2.25 million. So it's a huge, and just wrapping your mind around, this is a median sale price, right? So that was huge, and that was an all-time high. Toward the end of 2022, we started to see things dip as the interest rates rose, and just very quickly overnight. And so we see that drop, a little bit of the drop in the market coming down. This dip here is January of 2023, and that was at 1.485. By the time we got to last month, January numbers, the median sale price had come up over time through the course of last year. And then we've seen in 2024, January, the median sale price for last month was at 1.847500. So compared to 2022, it was at 1.888. And then if you compare to 2021, it was at 1.5 million. So you can almost draw a line seeing that just over time, the prices have continued to go up, even if you just discount this peak, you just equalize it out, and we're still doing better than we were before the pandemic. So prices have still remained relatively high. Again, it's not 2.25, but it's nothing to sneeze at, definitely about 1.85 million. It's huge. Part of the reason for that, as many of you probably know and have been hearing in the news, is inventory. And that's one of the biggest issues in our area. This metric is if you were to take the number of homes that are currently on the market and then sell them off at the rate at which they're selling currently, how many months would it take before you ran out? And if you would run out quickly, that would be 1 or 2 months, then that means that demand is high and whatnot. And if you have a lot of inventory, that means that things are sitting on the market longer, et cetera, or you just have a lot compared to your demand. Traditionally, 6 months is considered a balanced market. So that's this green horizontal line here. And then you can see going back to 2008, where we were hitting at some points 10 months of inventory, a lot of inventory. Part of it was just things were sitting on the market and people were not buying. It was difficult to get loans, or more difficult than it had been. And then a lot of short sales and foreclosures. So things were just taking a lot more time to move. Again, I started real estate in 2008, and it took me 8 months to get my first deal. So it was quite a challenging time. Since then, since about 2012, 2013, we've seen that number, the inventory levels hovering right around the 2-month mark. That's this lower horizontal bar here. And so, there were times at which it felt like, oh, it's getting more toward the buyers. Still, our amount of inventory was still very low, and it has been. As you can see, here's the COVID lockdown. And then remember how I told you there was that peak during the 2021 and 2022 season? Well, you could see here the inventory levels were at like 1 month levels. At several times during the year of 2022, it was at 0.9 months. In November 2021, it was at 0.8 months, which is 3 weeks worth of inventory. So if we got no new inventory coming on the market, we would just be out after a month or so. A month or two. So this is a story that continues to be an issue for us. There are two main I words when it comes to our market. One is inventory, because we've had such a lack of inventory. And even during the 2008-2009 period, I would go to seminars and the economists, and we're all saying we're not building enough new inventory. And so we are going to have a severe inventory shortage years from now. And that definitely has come to fruition. And that impacts because there's not enough inventory. Obviously, then if you have more demand, you're going to have that competition for it, and the prices rise. So that's what we've been seeing. Another metric I like to use is the days to sell. This is how long does it take from when you go on the market to when you get an offer accepted. And just intuitively, you can think the longer it is, that means it's sitting on the market longer. The shorter it is, that means they're moving quickly. This lower bar here, horizontal bar, is 10 days. So we've been hovering back and forth between 10 and 20 days since about 2012. So again, things moving quickly. I know after COVID, it got even more. And you see this line here where it goes down to 0. That's just because the MLS, our multiple listing service, decided to pause the time clock when the lockdown kicked in, because we were, the MLS, none of us was sure, we couldn't show houses. We couldn't do open houses for about 2 months. And so we weren't really sure what would be happening. And so it wasn't really fair to say a house was on the market when it wasn't really able to be shown. So that's why there's that 0 here. But other than that, it's been hovering about 10 days or so. We did have a little peak here of 30 days, 29 days actually, and that was January of last year. So that was kind of the height at which that things were getting more and more, taking a little bit longer to sell. Since then, as of January of this year, we're at 19 months. 19 days to sell. And most of the year last year was somewhere hovering between 12 and 9 and 17 days. So very quick turnaround period. I know in other parts of the country, there was big news about multiple offers and things going quickly and going way over asking. We've been actually dealing with that for about 12 years now. So it wasn't really news to us. It just got a little more intense during those times. This is just to show number of sales, and that's to give you an idea of just how over the course of the year. So you do see the seasonal trends. So every year it goes up and then comes down a little bit. And those down markers are going to be the December, January numbers time frame, because during that time, less listings come on the market as people focus on the holidays. So that's traditional and that's pretty usual. But one thing that I wanted to point out is that you can see, even though this one goes back to 2010, you can see that the last 2 years, the 2022 and 2023, the number of sales are just incredibly low. So our inventory has been low, and as a result, of course, that follows with that is the number of sales that happen is very low, and that's something that we're not seeing much of our way out of just yet in terms of resolution. One of the biggest factors of that, obviously, is interest rates. So this is from Freddie Mac, from the Freddie Mac website. So as of yesterday, this was at as of February 22nd, the 30-year fixed rate mortgage was at 6.9%, and it's bounced up and down since then. But you can see here how this goes back to 2021. What was happening with us is that over the course of time, over the course of 2022, people who were looking at 2 to 3% or 4% interest rates, over a matter of a couple months, it started jumping into the 5s. And then by the time we hit the fall, we were steadily in the 6s and 7s. And at some points you would see over days, it would bump up to even over 8. So a lot of that was going on. By the end of last year, we were still in the high 7s. And thankfully, between October and January of this year, we did see about a 1% interest rate decrease overall. So again, that bounces up and down, but that's the fact that it's normalizing, that it's kind of come down a little bit, is helping a bit to ease some of the burden in terms of the demand. So we've always had inventory issues, but for a period of time during this time, we started seeing some buyers kind of opting out of the market a little bit because the interest rates were almost doubling and hurting their buying power. And so we saw the prices come down a little bit, but because the inventory is still low, it doesn't come down that much. It keeps it stabilized to a certain degree. So the interest rates are what restrict the buyers. The inventory is what means that we don't have enough listings and sellers. And so you can see that whole effect making the sales volume go down. And then this is one of my last charts, but the 30-year fixed rate mortgage over time since 1971. And you can see 6.9% hasn't been great. And within the last 2 years, this jump up, and then now we're at 6.9%. If you look at it from a historical perspective, though, it's still fairly good, because there was a period of time in the 80s where interest rates, and I know some people who purchased during this time, and it was that one of our agents purchased at 18%, a little over 18%. Of course, he's refinanced since then, and the housing prices were much lower back then. But nonetheless, just taking it from a historical perspective, this is not an awful interest rate, and all predictions that we're hearing is that the Fed is it's just a matter of time of when they're going to reduce the rates. It may be June, it may be later. People were hoping it might be sooner, but that sounds like maybe not. So it's still uncertain. Depends on the economy, and I'm watching the economy because literally if the economic news is good, it's not great for our interest rates. And that means, and so it's kind of a good news, bad news thing. But so that's where that, in terms of in the field, definitely we're seeing a little bit of pickup in the inventory, just because seasonal trends, usually after the Super Bowl, and we're all sad here for our 49er loss, but usually after the Super Bowl, we start seeing inventory picking up. I am seeing some, but not as much as expected. Hoping that since March, April, May tend to be our prime selling seasons, hoping that there will be more inventory that's coming on the market. Definitely the buyers are coming back in. And so we're seeing people who are, now that the interest rates, we're talking more like 6, some cases 5s, depending on what kind of a loan that you get. So it's becoming more palatable for buyers to be able to come back in. The difficulty with that is there's not much inventory, and it is being competitive. So some of my colleagues, I've been hearing from 40 offers, 12 offers, and whatnot. And all of our open houses have been very busy, very well attended. So that's what we're experiencing there. So that's a quick update on the market, or not so quick update on the housing market. And then going into transitioning to your next home. And so before I do that, I do want to draw your attention to, we have on our YouTube channel a Savvy Home Selling series that we did at the end of last year. That goes into all the details of preparing your home for sale, some of the recommendations in there and what it takes. And then also there's one that's on navigating costs and taxes when you're talking about selling your home. So I'd really encourage you, because I'm not going to go into that detail today, but really encourage you to look up our YouTube channel and watch the videos. If you're thinking about selling in the near future, definitely there's a lot of helpful information in there. So, and I won't, again, be going into that kind of detail. In terms of the, so moving on to this section, why move? Why do people move? One of the number one reasons why people move is to be closer to loved ones. There are different ways, whether downsizing to a smaller home, especially if maybe children are out of the home and living elsewhere, whether college or setting up their households elsewhere, and you just want a smaller home as well because it's more manageable. Upsizing, needing a bigger home, and we're actually seeing more people doing that as well, where we have a multi-generational living. And so you want to buy a bigger home so that you can live there with your children and grandchildren. And considering the housing prices, we're talking about a little less than 2 million as a median sale price. It is getting more difficult for our children to purchase a home, right? So it makes it possible if you have that. It's nice to have that option for a multi-generational living. And so that's why we do see some people actually upsizing. And then retiring may want to wish, not tied to their job anymore, or maybe remote working, may wish to move to less populated areas or different climates, something that will be a little more tenable for you. So if you're planning to sell your existing home and buy, there are basically 2 options that you can do. You can sell first and then buy, or you can buy first and then sell. So the first option, sell your existing home and then buy your new one. Well, what are the things that you need to consider with that? First of all, if you sell your existing home, the nice thing about it is then now you have the funds from that sale to be available so that you can go out and now purchase the new one. Right? It makes it very easy. One way that you can handle that, if you're living in your home and so you want to know, well, how do I handle that? How do I sell it and then not have a place to go to, right? So one of the ways that you can handle that is to request the sale to be contingent on your finding a new place. So you can put that in the remarks when you're selling, or instructions for offers, because I like to do that for my listings, where I actually write up a list of things that we would kind of a wish list to make this offer great. And then we can talk to and negotiate out with a buyer to say, okay, I'm going to sell to you. I'm good with this price, but I would like you to give me some time before we close so that I can find a new place. This is it really is market dependent on whether it's or not it's going to work. It may work in our area because you have buyer, again, the inventory is low. And so you may have a buyer who's not necessarily in a hurry to buy, but they like the fact that they can lock into buying. That time period is not going to be indefinite, so you do need to put that into your contract. And it can be a little bit tricky because once the time starts ticking, it can be stressful. So it's not always possible, but it's something that can happen. The other thing that you can do in addition to this or just separately is to request a rent back period after the close of escrow to allow you some time to move. So you would actually close escrow. Somebody would give you an offer on the house. You would go ahead and close escrow, get your money, but then you would have the option to be able to stay. And literally now the buyer becomes your landlord and you are renting back the house from them for a period of time. This can be limited because, and that rental can be free in some cases. If you're in a good competitive situation, sometimes buyers will offer for you to do that for free. Or it can be for a specified rent. Sometimes it will be like the buyer's PITI, the principal, interest, tax, and insurance, so that the cost of the buyer is being taken up by the seller as they're renting out the property. This can be limited because if the buyer is getting a loan, is getting financing for them to move into a home, so owner-occupied home, the banks generally don't like that period to be more than 60 days. So that can be limited, but you can maybe do a little bit of a combination of requesting the sale to be contingent plus a rent back period. And then during that time period, it can be a little bit stressful because you're trying to find a place to buy, right? And if the place that you're moving to has limited inventory, that can be a little bit of a challenge. And you don't want to be in a position where you're stressed out trying to find a place. But again, the nice part about this is that at least you have the money so that you know if you close, once you close, you have the funds so that you can fund that purchase. A few other things about that. So even if we do negotiate the contingency on finding a place and you kind of pick out that time and then you have a rent back, all of that, there's still the possibility if you don't find a place that you may need to move twice. So you would have to move out of your existing home once it's sold, and then stay somewhere temporarily and then move into a new home. That can be really daunting for people. So it's not ideal, but some people don't mind that and can handle it, but it can be very daunting. The other thing about this is that if you're selling your existing home first, that means you're living there. So unless you move out, that's one option, move out and sell. If you're living there, the home may not show as well due to your personal belongings. And I know there are some homes that I've been to where it almost looks, it's beautiful, but a lot of times it's going to be your personal stuff, personal items that are in there. And generally people don't live in homes as if they were staged, right? You just need to live. And so that can make it not show as well, which could impact the kinds of offers that you get, because buyers coming in are looking at a home, and if it's personal to you and all your family stuff is there, or your personal belongings are there, it's going to be a little bit more difficult for them to think of that as their personal possible home, future home, right? So it may not show as well. And then also the showings may be limited because you might need to do it by appointment and whatnot. And so that can actually stifle a little bit in terms of the exposure. And so the exposure to the home will be possibly less. And then you also have, and on top of that, the last point, it may be stressful because you need to be ready for those home showings. And that can be harder than you think. I have some clients some years back who were like, oh yeah, we're fine. Just give us a couple hours and, notice, and we should be fine for showings. And by the end of the first week, they were like, can we get offers now? Because we're tired. And the husband had a little to-do list of whenever somebody's coming over, make sure you put the toilet seat down, make sure you turn on the lights, open the door, etc. So it can be very stressful to go this route. It is possible to do, but those are some of the considerations if you're going to be selling first and then buying. So the other option is to buy first and then sell. The advantage of that is it gives you time to know for sure, well, you'll be moving. So I mentioned it could be stressful if there's limited inventory and you're on a time clock. Now trying to find a place it can be very stressful. And so if you buy first, you have the wherewithal to be able to buy the new place first. You can take some time. And then when you find the house that's appealing to you, you can go ahead and buy it, right? And in your own timeline rather than being rushed into it. You can then move directly into your home and then have time to prepare the house for sale, which will make it, vacant homes will show better and will be easier to show. If they're easier to show, you get higher exposure. The people who come in, more buyers coming in, it will show better. If it shows better, you're going to get more possible offers. You get more possible offers, you get a higher price, right? So this is really ideal if you can do that. One way that you can handle doing this is to make the offer contingent to the sale of your existing home. So you can actually be going out and writing offers, and in your offer, you would say, contingent on buyer selling their home, selling their property. This really depends on the market. And most of my career, I've been in a low inventory market. I have not done a single one of these, because if you're in a situation where, oh no, I actually have done one. And that was because that place was on the market for a little while and we were the only offer. So the seller was willing to work with us on it. But if you're in a competitive situation, this is going to be one of the contingencies that hurts the most. Needing to, and it really depends on the market here, but again, considering our market, that's what happens. If you're relocating to another area, it's good to get an idea of that market. Maybe if homes are taking a little longer to sell, you might have some leverage and be able to make this contingent. The other piece of that, though, is that whether you make it contingent or not, ultimately you need to be able to finance the purchase apart from the sale of your home. And so whether that be your down payment, because down payments, especially if you're looking at close to $2 million median sale price home, right? You're even if it was $1 million, the down payment you're looking at easily $200,000 to $200,000 if you're doing a 20% down payment. So you need to come up with those funds because you haven't sold the home yet. The other piece of that is if you do get a loan, then you may end up, first of all, you may not qualify for two loans at the same time because you have your existing loan, possibly, and then you have the other, the home that you're buying. And so if you have a mortgage already, you might be paying two mortgages for a period of time. And so that can be a difficulty in itself. So the solution to that is bridge loans, which we're going to get into. I'm going to do a little bit of an aside, but before we get into that, but bridge loans is one way that can help you so that you can buy first and then be able to sell your existing home and do that on your time frame, but still have an offer that's competitive. And Elsie will go into that, so I don't want to steal her thunder. But this has been, the bridge loans have been really a game changer for so many of my clients to be able to do this. So before we go into the bridge loan, I did want to touch a little bit upon Prop 19. And this is dealing with the portion that helps you keep your property tax base when you're moving. This has to do with, this only applies to your principal residence. So that's property which you've defined as your principal residence for at least 2 of the last 5 years. That's the rule. One of the best ways to establish principal residence is, or to figure out, if you have multiple homes and you're like, which one is my principal residence? It's going to be the one through which you get the homeowner exemption with the county. So when you get your property tax bill, there will be a little homeowner exemption of $7,000 off the value, which is not that much, but in any case, that's your principal residence. Sometimes you can tell if you're also been renting. So if you have a rental property, you have a property and you've been renting it out, that the Prop 19 will no longer apply. So keep in mind, the other way to keep, to know what it is your tax returns, right? So if you have been claiming income from a rental property on that home, then that is not your principal residence. Okay, so it could be a portion of it, which is a different thing. But if that whole property has been used as a rental property, then you cannot use Prop 19. As a quick overview, the eligible homeowners for this are those who are 55 and up, 55 years old and up, or severely and permanently disabled, and then also victims of wildfire or natural disaster. That's something that was added in for Prop 19. This allows for the transfer of your current property tax base of your principal residence to the purchase of a new principal residence in any county in the state. And it used to be that there were only some select counties that would participate in this. It was Prop 60 and 90 years previous to Prop 19. Now you can move into any other county in the state. there is a time restriction, so it does need to be done within 2 years of the sale of the original residence. So it can be before or after. So you can sell and then buy, or buy and then sell. Either way, it doesn't matter as long as it's done within 2 years. You do need to be 55 at the time you sell your property. Whichever order you do it, you have to be at least 55, one of the spouses, if you have spouses. And then as an overview, for purchases of property that are equal to or less than your original property, the taxable value of the replacement will be the same as the value of the original property. We say taxable value because it's not the tax rate, it's the taxable value. And then depending on where you move to, they'll be taxing you at their rate with your taxable value that you held. And it also allows, which is new for Prop 19, is that you can purchase a more expensive home and there is no limit on that. So prior to Prop 19, you could purchase more expensive home, but it was only about 5% more in the first year and 10% more in the second. Now you can actually buy a more expensive home. Doesn't matter, but there's going to be an upward adjustment in the taxable value. So quickly with that, an example scenario, if you purchased a home 30 years ago for $110,000, good for you, and you should have bought, we should have bought more at the time. But in any case, $110,000, the current taxable value is now $200,000 because there is, due to Prop 19, there's a 2% cap on the annual increase over time. So even though the property values have risen by quite a bit, the rate at which the property taxes have gone up is much slower. So for this example, we're going to say that now the taxable value for this property is at about $200,000. The property tax bill, if you estimate about a 1.1% assessment, is about $2,200 per year. And then the current market value of the home is $600,000. It should be more than that, but for some reason I picked $600,000 at this time. So if you were to purchase a home of equal or lesser value, what would happen? Well, the market value of the home is $600,000, so you sell for $600,000, and then you purchase a home for the same $600,000 or less. Then what happens is that your property, the taxable value is unchanged. So it'll still be that $200,000 that we had talked about. And so the property tax will be about $2,200 per year. It's not actually unchanged because you're not taking your taxes. You're taking the property taxable value. And then depending on the locality of where you're going to, the county, they may have other local taxes and things like that. So you might have a little bit of a difference, but approximately the same. The main part that is based on the value of the home will be reduced. So you can keep that $2,200 per year that you were paying, or estimate. And then the second is if you were to purchase a property that's more expensive, so you sell for $600,000 and then buy a $700,000 property. Here we see $600,000. The difference between those two is $100,000. Right? Your prior home's taxable value was $200,000. So they just take that gap and add it on to your prior home taxable value, and you end up with $300,000 instead. So if we estimate about a 1.1% tax rate, and again, that can vary depending on where you're going, your new tax could be approximately $3,300, which is an $1,100 in annual property tax. That's nice if you think about if you purchase $700,000 property, and the tax rate is approximately 1.1%, you would be looking at a $7,700 tax bill, right? So now you're looking at $3,300 versus what could be a $7,700 tax bill. And so this is kind of a nice thing. Again, you need to be at least 55 years old when you're selling the existing residence. It can be just, if you have two spouses, it's okay if only one of them is 55, as long as they're on title and whatnot. It's okay if the other one is not yet 55 years old. It can be exercised up to 3 times, which is a new thing. So you can actually do this. People are living longer. 55 feels a lot younger to me than it used to be. And so, there may be, when you're 55, you have different needs from when you're 85 and during and in between. So there may be different things that you want to do along the way. The process at which you do it is you file an application with a tax assessor in the county that you're going to. So whichever you move to, that's where, and all of them have websites where you can download the application and take a look at it, and their brochures and whatnot. So you can take a look at it. And again, the transfer is of the base tax base year value, not the tax rate, which can differ depending on county or area. So that's in a nutshell what happens. But, I did want to cover that because a lot of the times people who are upsizing, downsizing, relocating are going to fit that 55-year-old or higher metric. And so this is a really nice tool to be able to use. Some final notes. Keep in mind, though, that you'll still need to consider what your capital gains tax liabilities may be. So I'm not a tax person, so you need to talk to your tax person to figure out what makes sense for you. There is if it was your principal residence, which is what we're talking about, there is the homeowner 121 exemption of $250,000 per individual or $500,000 per couple. So there's that in there. And then there's also a possible step-up basis if one of the spouses passes away, and that you really need to consult your tax advisor or an attorney and just figure out, make sure that your trust or whatever you do is structured in such a way that will allow for that transfer to the surviving spouse. Otherwise, and I've heard, in previous to the community property rider survivorship, there used to be, they didn't have that. And so a lot of the spouses might have purchased as tenants in common or joint tenants. And if that happens and one spouse passes away, then the step-up basis only applies to their half. So again, talk to your tax person, because I'm just telling you what I've heard. I'm not a tax specialist, but these are some of the things to consider. So even if you are able to take your property tax with you, you also need to think about what makes sense for you in terms of your capital gains liabilities. Okay. So with that, I'm going to hand the baton over to Elsie, and she's going to go over bridge loans to help you buy before you sell.
Great. Thank you, Jean. So it's purely coincidence that Jean and I both have our company names reflecting the concept of abundance, because we both believe in serving the community, in making sure that everyone can share in the abundance. So we bump into each other by email, and it's very nice that she and I have the opportunity to work together. And the more I work with Jean, the more I admire what she is doing for the community, not just in Millbrae, but other real estate agents, and then other counties also. So Jean has done a great job. And I also recommend, for those of you who don't know that, to go to her YouTube channel. She has a good library of information about real estate in general. So the topic for today is, of course, transitioning to your next home. And one of the tools that many of you on the call who have worked with abundance before is familiar with is this notion of bridge loan. And in the industry, bridge loan has many, many definitions. It generally means a short-term loan. And in this context, we're talking about a short-term loan for owner-occupied homes, for homeowners to buy before they sell. So Jean, next slide, please. So what is a bridge loan? I mentioned this before. In our context, it is only for people moving from one primary residence to their next primary residence. And the reason we mention that is because there are special federal regulation exemptions, so that we do not need to look at current income. So people who are retired, who are deferring their Social Security until a later time, they may not have enough income to qualify for any loan. Or people who have a mortgage now and who is on, they may not be able to qualify to carry two big mortgages at the same time until they sell one of the houses. So the notion is that we want to help people using the equity of their home to buy the next home first, move into that new home, and then sell the existing home. Very often our bridge loans, because a lot of the Bay Area residents have significant equity in their homes, there's no down payment for the purchase. And the way we do that is because, let's say they own a $2 million house with very little debt, let's say $200,000 of debt, and then they're buying another $2 million house. So the total value of the two properties is $4 million, and they only have $200,000 of loan. So it's a no-brainer for us to lend them $2 million for the purchase, because the loan to value for the two properties combined would be something like 55%. So that's really safe for our private investors who are usually the lenders of these loans. And the banks don't do these bridge loans because banks are after long-term residual income. And very often our bridge loans pay off in 3 to 6 weeks. We've had one that paid off in 2 weeks, and then sometimes they do last 3 to 4 weeks. But very often when a real estate agent is working, a home buyer, home seller is working with a seasoned real estate professional who knows about bridge loans, like Jean, they would time everything up so the duration of the actual bridge loan is very short, and therefore the borrower would only pay for a few weeks of interest. So who actually looks at, who actually are the bridge loan borrowers? Jean, if you go to the next slide. Initially, when we thought of bridge loan borrowers, we were thinking, okay, so maybe these are people, a lot of people would think that these are people who are struggling financially. But in reality, in our experience, most of the bridge loan borrowers are very financially savvy. And we've done a bridge loan recently where the gentleman has, I think, $20 million net worth. And he was in his 80s, and he was actually donating a significant amount of his net worth to some kind of a scholarship, university scholarship in Southern California. So he's not short of net worth. But he was looking at his overall portfolio. He was thinking more strategically about how he can save on taxes and still be able to buy the new home when the right one comes on the market. So very often these are sophisticated homeowners, very often financially very, very strong, and very often they're working with savvy advisors. And that includes real estate advisors and financial advisors. So we've actually had private bankers and private financial advisors referring their clients to us for these bridge loans. So why do they do that? Jean, if you go to the next slide. Well, I mentioned this earlier. Very often people cannot qualify to have two mortgages at the same time, or at least two big mortgages at the same time, especially if they need the equity from one home to help them move into the next home. So that's one consideration. But the second consideration, and this is very common, is that they don't want to liquidate stocks and pay the capital gains taxes. So if you look at the federal capital gains taxes, the state capital gains taxes, and there's that Medicare, additional Medicare coverage gap on the capital gains taxes, you're looking at 32 to 35%, I believe. So if you think about a couple that's trying to buy a $2 million home all cash, and let's say they own their current home free and clear. So if they want to buy a $2 million home all cash, they had to sell about $2.8 million of their stock portfolio and pay around $800,000 of taxes, capital gains taxes, in order to have enough money to buy the home all cash. And this assumes that they have a $3 million stock portfolio of that $500,000 cost basis. So that's a lot of money. And once you pay the government, you're never getting that money back. So for a bridge loan, for example, if they end up having to use a bridge loan to buy the new home first before they can pay down or pay off the new home and refinance after they have sold their existing home, then let's say we're looking at 3 months of interest. That works out to be about $52,000 for a $2 million home, and about $60,000 of loan origination fee. This is on the higher end, but we're using that for example. So the total cost would be about $112,000 versus the $810,000. So this is why why we have found that many of our bridge loan borrowers are very financially savvy and very financially strong, because they know that they need to plan for another 20, 30 years because we're all going to live into our 80s, 90s, and 100s. So they're thinking ahead about some of these factors. And then, of course, with a bridge loan, because we can do 100% financing, it is almost as good as cash. And that means that gives the home buyers leverage and negotiation power with the sellers of the homes that they're trying to buy because they can make a non-contingency offer. Okay, so the next slide, please. So very high level, and of course these interest rates and points and fees all change. But this is a rate right now from the market, including our own private money loans. So the interest rate starts at 9.75 to and goes to 10.95. Very often, the large Wall Street players will reduce the interest rate if the loan to value is really low. And of course, they are looking for excellent credit. And they do that because, again, there's no income qualification needed for these bridge loans. So the credit scores are actually very important. The loan origination fee is high also because, again, these loans have no prepayment penalty. So if a lender is generating the loan, there's a lot of upfront paperwork, a lot of overhead. So these lenders somehow need to recover their overhead, and therefore they're charging higher fees. And quite honestly, they look at the total savings in terms of the home buyer's capital gains taxes, and they feel that 2 or 3% is insignificant in the big picture, in the overall scheme of things.
And so, Elsie, just to chime in, so the interest rate, that's on an annual basis, right?
Yes, that's on an annual basis. Right. Yeah. Thank you for that. Okay. So a few other things that's very important to mention here. These bridge loans are only supposed to last 11 months. So in the private money industry, the attorneys say, no matter what you do, do not give them an extension. Because if you give them an extension, then you are violating the federal regulations about no income verification, no debt to income ratios. So if you're thinking of a bridge loan, make sure that you get everything lined up so you will be ready to sell, and you're working with a seasoned real estate broker who can help you sell and for a good price. There is going to be interest-only payments. So like I said, sometimes these bridge loans only last 3 weeks, 5 weeks. So then the interest-only payments is actually somewhat insignificant in the bigger scheme of things. Especially on the bigger homes, some lenders may require 2 appraisals. Some lenders may require at least 1. So that varies a little bit. The federal regulation says that all the closing costs has to be paid out of pocket. So we advise our clients who are thinking of a bridge loan, don't wait until they only have $50,000 left in their bank account, because they need that money to move, and they also need that money to pay for closing costs. Of course, they can borrow that closing cost from family, from friends, or from their retirement account, but it would be better if they don't wait until they, their money is all tied up in real estate or other funds. And then there's HUD counseling. So imagine when we're having the conversation with our $20 million net worth borrowers that they need to go through HUD counseling. Very often we have to apologize to them in advance that that they will be asked really silly questions about whether they know how to read a mortgage statement, whether they know if they have enough money to service the mortgage. But again, that's a federal regulation. And every now and then we have lenders who will allow the home, if there's enough equity, they will allow the homeowners to keep their low interest rate first mortgage or their line of credit and use that for their moving expenses or to get their homes ready for sale. So that's also very beneficial to our borrowers. So then next, I want to give you 2 very recent examples of bridge loans that we've done in the Bay Area. The first one we actually just closed last month. And this couple they just retired. They haven't even started drawing their retirement yet. They live in Mountain View with no mortgage on their home except a line of credit for $500,000. And their daughter in San Francisco has said, hey, mom and dad, move closer to us and we'll take care of you as you age. So this is wonderful. And the daughter found that there was a home in their area that was lingering on the market. It wasn't selling, so the sellers asked the real estate broker to remove the staging, and they were going to put it back on the market at the end of January. So then I think right around Christmas time, we got a call from the real estate broker representing them for the Mountain View home. And with the introduction, we gave them a pre-approval to buy this house in San Francisco. They were able to negotiate the price so that it's actually $225,000 below the asking price, and they were able to buy this off market before they put it back, before the San Francisco sellers put the property back on the market in the better selling season in San Francisco. And the reason that they were able to get their offer accepted was because they had a cash-like offer, quick closing with no contingencies. And that was important, especially because the seller has already gone through some disappointment of not being able to sell at the prices that they had wanted. So now, the day after they closed escrow on that San Francisco property, they moved out. They had the movers ready, they moved out, and their real estate broker is working on getting their home in Mountain View ready for sale. I think they'll be on the market in a few weeks. So this is a win-win-win for all around. The only shocking part for this was the property insurance. So the property insurance turned out to be, I think, around $20,000, which is something that I'm sure, Jean, you'll be talking about, or you have already spoken about in your seminars. But this is a great success story. They bought a home with with 100% loan for their entire purchase price. They were able to keep their line of credit for staging, for renovations, to get their Mountain View home ready for sale, and they got a house below market. It was a really low stress scenario for them. So the next one is interesting also. This is interesting because it's multifamily and it's helping a teacher buying a home through a divorce. So husband and wife bought a home together, later on added the wife's mother onto the title. So all three of them were on title. And then the husband and wife were getting a divorce. So they decided that they would go their separate ways after the wife and the mother buy a new home together and move out. So what they actually did was, what we were able to do is help them do a bridge loan from a three co-ownership scenario into two co-owners, where it's just the wife and the mother. And we were able to keep them. So after the bridge loan, after they sold their existing home, we helped them refinance their new home, and they were able to just have the wife, who's a teacher, on the loan. So the mother was not even on the loan, and everybody was very happy. All three people were very happy, and the sellers were all right. The buyers were happy with their new home as well. So it was also a very it's actually pretty typical now of mother and daughter moving in together. So we were very happy to be able to do this complex bridge loan for them in this scenario. So going back to transitioning, so are there other options for buy before you sell? Yes, there are. For example, there's the notion of asset dissipation loans, and but that, if you have a $5 million brokerage account, or if you have a $5 million self-directed IRA account, then your income, you're at an age where we can start counting on your retirement account distribution. Then we can look at some formula to see if we can liquidate your brokerage account or your retirement account to qualify for the loan, even though you would not need to actually sell your brokerage account or liquidate your brokerage account or your retirement account to qualify. But the problem with those loans is that they're harder to qualify. They do require a lot of paperwork. And if they are dependent upon your brokerage account and the brokerage market, stock market corrects, they're going to call some of that. They're going to do a capital call for you to replenish that stock portfolio. So there are a few other options as well. But what we Abundance try to do is that we do both private money loans and we do conventional loans. And we want to be the one-stop shop to help clients navigate this very complex lending world, especially with today's high interest rate. And bridge loan is one of the most popular solutions that we have to offer today. So with Jean, I'm happy to take any questions, or we can do questions later also.
Yes, so thank you very much, Elsie. So this is question time. So I'm not seeing any in the chat, but does anybody have any specific questions that you want to ask? Just Elsie, just to ask you in terms of, and I know the answer, but for other people, for the bridge loans, how long does it take to close usually? How long is the process of even getting set up? If somebody finds a home today, and this has happened to me where somebody says, oh, we're not really looking, and then all of a sudden they go to an open house, love a home, and they're like, let's move. And so if they call you up, what is the process? How long does it take? And then how long does it take to actually get it closed if their offer is accepted?
Right. So at our company, if it's under $2 million, then we can do it in-house with our private investors. And for that, we can generally do a pre-approval within 24 hours, so next business day. And we can generally close escrow 21 days later. And the reason for the 21 days is because of all the mandatory waiting periods, mandatory disclosures. So we have to wait 4 days after the initial disclosure, and then 3 days after the next disclosure, and then 3 more days after loan docs are signed. So 21 days altogether. But generally, by the time that we give a pre-approval, we feel very comfortable that our clients can submit an offer without any contingency. Now, on the bigger loans, let's say someone is buying a $3 or $4 million bridge new home, and they want the entire purchase price, $3 or $4 million purchase price, to be financed through a bridge loan, then that may be about 28 days. So actually, we can probably close escrow sooner than the real estate agent can get property insurance.
Yeah, property insurance is the other. It's all the I words, right? We got inventory, interest rates, and now insurance that's messing us up. So that's a big thing. We have done a seminar on that. So I'm not seeing it. So we talked about this as principal residence. You do have an option for rental property too, right? Investment property. It's a different one, but you do have bridge loans for that will cover.
Right. We have bridge loans for reverse 1031 exchanges. And then we also have, so that's for investment properties. And then we also have other loan programs where we can combine different rental properties to lower the loan to value on a regular owner occupied bridge loan. So we can do all of that. So as private money lenders, yes, we do have to follow federal and state regulations, but we also have more flexibility on the different types of properties we can take. So, but Jean, I have a question for you. Well, okay. Jean, for the group, we get this question a lot. People moving out of state. Do you see a lot of people moving out of state or out of the area?
I have been. So, and generally what it will be is, as I mentioned, one of the big reasons why people move is to be closer to their loved ones. So I'm actually seeing and talking to somebody a family next week where the kids grew up here with their parents are here, and this one happens to be in San Francisco, and then the children move out of the area, and then as they grow older, now the parents are in their 80s and 90s, so they're needing to the children want to move them closer to where they are. And so they're moving. So I have clients who've moved out of the area, one going to Sacramento, one going to Michigan, to Wisconsin, just depending on where their children are at. So that's that's the majority of what I'm seeing. Not as many people who are moving to retire. Uh, that is a different thing. And so that we're actually going to cover at our March session where we talk about buying investment properties and structuring it in such a way that eventually you buy your retirement home. So I am seeing some of that, but most of what I'm seeing is people who are moving because their needs have changed and they want to be closer to family, and a lot of their family is somewhere else. That's more
Interesting.
of what I'm seeing. Yeah.
So from a bridge loan perspective, I would say 80 or 90% of our bridge loan borrowers are remaining in California.
Mhm.
They're choosing to remain in California. We are able to lend bridge loans if they're, for example, selling a $2 million home and moving to Texas or moving to Florida. In that case, we would just use the California property, the property they're selling as a collateral, and that works too. But it's interesting that you and I have similar but also different demographics from our different perspectives.
Right. And I mean, I am seeing people who are also just moving within California as well. So there is that, but it's kind of a mix. And a lot of it does, like I said, is driven by where where their children went to. That's where I'll
Yeah,
see most of that transition.
yeah,
People who are still mobile or whatnot will generally stay closer. So closer to the area because it's where your lifestyle is already set up. So that's what we're
yeah,
seeing.
right.
Um, any other questions? We did such a good job that nobody has questions, Elsie. So
Jean, you should talk about the other topics you have in the
I am. So
okay.
with that, since I'll go into the announcements, we're such a good team. You can lead me through. And I didn't get to say when Elsie started, Elsie was talking about how we met. It was literally because one of my agents saw an email from Elsie and said, "Hey, there's a company called Abundance, and Perisson is Abundance." And the color of your email at the time was some kind of a teal color, similar to my background. And so he sent that over to me, and then ever since I've loved partnering up with Elsie on so many things, and she's actually helped my clients directly, both for reverse mortgages as well as for investment properties as well as primary residence. And it's just nice to have that in the toolbox. Yes, the interest rates are a little bit higher, but when you think about, as she gave that example, uh, selling your stock to purchase the home, you're going to pay a lot more in capital gains and you lose that, right? You're not going to go, it's going to be more difficult to go back and try to rebuy the stock. So I'm not a financial planner, but the people who are, I'm sure, know the value of this. So with that, a few announcements. As I said, we have our continuing on in our real estate and finance in the golden years is on March 13th. This will be in person in Millbrae, retirement and relocation strategies. And I have, in addition to Elsie, my favorite people, Ron Ricard from IPX 1031 and Joe Daly, who's a CPA, will be talking about how you can use the homeowner 121 exemption, combine that with the 1031 exchanges, and eventually swap it until you get to a retirement property that you enjoy. And being able to combine that and defer your capital gains taxes until Ron likes to say you swap until you drop. So you keep swapping, and then you find the place that you like and want to retire to. You don't sell it, and you keep it until you pass away. And so you don't have to, those capital gains taxes that were deferred through the 1031 never get realized because when you pass away, your heirs get a step up basis. So a lot of interesting things. They're a great team, so please watch out for that. And I hope that those of you who are joining us today will consider joining us. It is in person, and we do have on April 17th, Dan Young, who is actually on this call, I think, will be doing Mastering Financial Essentials in Retirement. I'm super excited about this one because he's going to be talking about all the things to consider, Medicare, Social Security, long-term care insurance, just the whole gamut. So this is not so much real estate related, but everything is real estate related as far as I'm concerned. But I think this is super important, just to be able to, I'm inviting all of my friends and all the moms that we've graduated to our kids graduated together. We're all at that age right now where when we meet together, it's all health issues, Social Security, Medicare. We're talking about stuff like that. So I'm really excited for that. That will also be in person. And then May 15th, Investing Wisely in the Golden Years. And that will be Duncan. I'm sorry, I just forgot last name. Duncan Eng?
Yes.
Yeah, Duncan Eng will be speaking on, and this will be via Zoom. So even though whatever other investments you have, I know there's some who might be investing with Elsie's group, or if you're in stocks or you have investment property, what are some other options for investing if you want to? So Duncan will be talking about different things like annuities, DSTs, the Delaware Statutory Trust, opportunity zones. Long-term care insurance comes into that, and a bunch of other things that we'll be going into. So that will be via Zoom. And I'm really excited about those topics and hope that all of you will be able to join us for those. So with that, I'd like to thank everyone for joining us this evening. And I hope that this information was useful for you. If you need to, we'll be sending out an email that has Eric and Elsie's contact information. So if you want to learn more about the bridge loans and how to proceed, and then definitely if you have anybody who is, if you know anybody who's thinking of buying or selling and you don't have somebody representing you, I would love to be your resource as well. Thank you very much.